Hello, and thank you for joining our YouTube channel. This is Luke McCarty with McPherson Financial Group. We're gonna start a 7-part series with you today. I'm going to introduce to Mark Bernard, but what we're basically going to talk about mostly is the financial planning that we do here in-house and under the President Trump tax cuts. So, Mark, go ahead and tell a little bit about yourself and what you do for our clients.
Yes, my name is Mark Bernard. I'm a CPA for the McPherson Financial Group. I'm an in-house CPA. I do tax returns, tax planning, anything related to taxes. I work with our clients on trying to figure out a way to pay the lowest amount of taxes possible. And one of our biggest tools is what we're going to go through in this series, as Luke said. It's taking advantage of President Trump's tax cuts.
Yeah, so Mark and I have done quite a few in-person educational seminars. We've done some other webinars, and these are our main focus points that we've been doing over the past couple of years. There's a few more years left in this window, so we're going to get started here and give you some helpful tips and ideas and share some stories of what we're doing currently with our clients. So I mentioned this is a 7-part series. This first part here is going to be the introduction to the 4 buckets of income. You can see the other parts we're going to do here in the near future, but they will all be here on our YouTube channel. So what are the 4 buckets of income? Mark's going to go over those in quite a bit of detail. Each bucket is taxed at a different tax rate and a different potential tax schedule. We're also going to tell you why it's important to maintain all 4 buckets of income. Our viewpoint there is the way that you save into retirement is going to dictate how your taxes play out in retirement. If you haven't saved in these buckets throughout your career, we have this shortened window within the Trump tax cuts to get you there. Here's some of our disclaimers. We are we have a broker dealer. We have, we're an RIA, registered through FINRA, SIPC. So those are some of our disclaimers. I wanted to go over a little bit about kind of what we do and how we've been vocal in our viewpoints of the markets and the current tax laws. So we have a radio station. Mark's on the radio station. Mark, how often are you joining us, and kind of what are some of your most recent tips you've had on the radio?
So I think I'm on there usually about once a month, maybe twice a month, some months. The latest one was looking at the Secure Act 2.0, which is our second topic. And we kind of dived in to some of the benefits that have been put into place to help people retire, help people save under the 529 plan for their kids or beneficiaries' education. And there were some pretty nice changes there.
Yeah, there were a lot of changes that happened with that $1.7 trillion spending budget at the end of 2022. And we talk about this on the radio. You can find us on, our podcast on, iTunes, Google Play, Spotify. Of course, you're on the YouTube channel. Something else we're going to mention at the end of this video is an opportunity to receive Art McPherson's book, Nothing is Certain But Death and Taxes Until Now. It's going to have a few more client examples. It's a good read. It tells you kind of what we're doing and why we're doing the things we are. So we're going to jump into the 4 tax buckets here. I'll let Mark take over as the in-house CPA and kind of give you an update on how to get money in these buckets and how they are all taxed.
So Luke, the 4 tax buckets is fully taxable. That's basically your W-2 income, your pension income, things to that nature. Short-term capital gains go in there as well. It's the stuff that you earn during your career and continues to be taxable. Interest and dividends also fall into that bucket. We have the tax deferred bucket as the second bucket. And in the tax deferred bucket, that's your 401k savings. That's when you are working and you take dollars of your earnings, and before they're taxed, you put them into an investments tool like a 401k, 403b, or even a traditional IRA. We also have some other tax deferred situations with non-qualified annuities, and then some certain types of savings bonds. Long-term capital gains is the third bucket, and that's Luke likes to call it the Warren Buffett bucket. This is where Warren Buffett makes his money. He doesn't earn a salary that gets paid at the top tax rate as an ordinary fully taxable income. It's actually sales of stocks and investments. And when you sell those things and make a gain, they get taxed at the capital gain rates. It's generally your shares and REITs and other investments like that. And then the third one is the the fourth bucket is the tax-free bucket, which includes a Roth IRA, which we're going to get into a little more detail, municipal bonds, certain life insurance, and and a part of your Social Security benefits could also be tax-free. So these buckets, when something's in this investment vehicle, it comes to you in the form of distributions or however other ways that you may earn this income. It is not taxable and it does not come on your tax return. Anything
Yeah,
you want to
Mark,
add there, Luke?
of course. Yeah, Mark, I will jump in and say, when we onboard a new client here at McPherson Financial Group, I would say most of the new clients have the majority of their assets in the tax deferred bucket. It seems like we've been trained or taught or coached, throughout our lives while we're working is to save the tax now, right? Put it in your 401k, save the tax now. You will be at a lower tax bracket in the future when you retire. Well, what we've found is our clients more often than not are in a higher tax bracket when they retire, and they will more than likely be even higher tax bracket after the Trump tax cuts expire and we go back to the Bush-Obama tax code. So if you have most of your money in the tax deferred bucket, it's not the worst thing in the world. You still have the money, right? It's still there. You can still do tax planning over the next several years to kind of fill up all of these buckets. And of course, Mark, I like how you called me out on my Warren Buffett tax bucket, the yellow bucket. The story you always hear about Warren Buffett is that, he pays less taxes than we do. Well, not in totality, but maybe his tax rate, because he's at the top of the long-term capital gains bucket at 20%, and he probably has the net investment income tax of 3.8%. We'll get into all of those. But if you're paying more than 23.8% in taxes, you might pay more than Warren Buffett. So let's
That's
jump
right.
in. Yeah.
One other thing I wanted to add to this slide is, for most of our clients, our goal is to get all four of these buckets, and we're going to get into more detail. But it's important when you're going year to year, living life, unexpected costs, unexpected health issues. We like to see all four buckets so that when we're trying to figure out where the income can come from, we try to take advantage of optimizing your tax, having a lower tax rate and paying less taxes, and having all four of these buckets to fill up your tax return certainly gives us a tool to try to do that.
Yeah, and unfortunately, the new trend here in Florida is you need a new roof. We've talked to a lot of clients about the new roof. Well, if you don't have all four tax buckets, if all your money's in the tax deferred and you need a new roof, well, you're going to pay 25-30% more to get that new roof, to get it out of your 401k or IRA. So having these buckets are going to help you for those unexpected expenses, even if it's unexpected from the insurance company or, life as it can be. So we're going to talk now about the fully taxable bucket. I'll let Mark take over here and kind of talk about the graduated tax schedule and how that might play out on your tax return.
Okay, so generally what we're talking about are three different types of income. We're talking about income that goes on your tax return is ordinary income. And again, that's like your W-2 income or distributions out of your 401k, interest and dividends. On this schedule is what we use to calculate the taxes that are owed on income earned in the fully taxable bucket. As you look at the schedule below, this is updated for the 2023 tax year. This is part of President Trump's tax cuts that were passed in 2017. Those tax cuts came with an end life. So in order to get it through Congress and everybody sign in, the compromise was that we would put these tax cuts in place for 10 years. After 2026, they would sunset, and unless there's new legislation passed, we would go back to what we would call the President Bush-Obama tax rate schedule. But a graduated tax schedule, people might not really understand this, but you can see there's different layers there, Luke. We have the 10% bucket, 12%, 22%. It's called a graduated tax rate schedule. So if you look at the middle column, for married individuals filing joint returns, the first $22,000 of their taxable income is taxed at 10%. Income earned between $22,000 and $89,450 is taxed at 12%. Now, just because you went to $22,001 of income, you still get the benefit of that 10% rate. Only that dollar gets taxed at the 12% rate. And we go on and on. We have a slide later where we'll show you a side by side where it looks at the Bush-Obama rate schedule versus President Trump's rate schedule. and you'll see that the rates are higher, as well as what income is being taxed. So under the Bush Obama, you don't have to make as much money to get into the higher tax brackets.
Yeah, and Mark, when you run those analysis with our clients, what are you seeing kind of this tax code versus what we could revert back to? What kind of a percentage tax increase do you see most people having within your models?
Yeah, so if you're in the same income today versus in 2027, the same amount of income, you can expect in 2027 to pay approximately 25 to 30% more in taxes compared to what you would pay under President Trump's rate schedule.
Yeah, that's a big number. And just for reference, we're going to get into it here in the future, in future slides and future videos, but the majority of our tax planning happens in the 12 to 24% bracket. There's certain reasons why we stay in the 22 or below, and some reasons why we go into the 24%, but we rarely are doing, we're rarely causing taxation in the 32 and above, just because that's a high hurdle to climb, and you would need a very large portfolio to be able to get into that bracket, even back in the Bush Obama codes.
That sounds right, Luke.
So the tax deferred bucket, tell us a little bit about that, Mark.
So the tax deferred is when you're working and you're earning a salary and you say, okay, I want to get my employer match. I'm going to put 15% of my salary into the 401k, get the company match with that. Well, with that, you get a tax deduction. So when you have a salary of 100,000, but you're putting 15,000 towards your 401k, all you earn on your tax return for the year that you were working is 85,000 for that year. So you're not taxed, it's tax deferred until other distributions out of the 401k occur, or certain events occur that make it subject to being taxable. The big thing about, we also like to call this bucket, the tax deferred bucket, the qualified money. So these accounts are qualified accounts that are deferred to until you take a distribution out of the account. And part of what the government has tried to do, because people would historically not touch the money that's in the tax deferred bucket as long as they could. And the way the rules used to be written, Luke, is that you could pass without ever taking any money out of that 401k, go ahead and send that to your kids, that IRA account. So it would now be an inherited IRA, and they too could sit on it as long as they wanted to. So what the government did in response to that, there's been two Secure Acts. We talked about Secure Act 2.0 that was passed last December. Well, there was also another one that was passed under President Trump that created the required minimum distribution, otherwise known as an RMD. And what these rules tell you, and we're going to get into more detail about it, but when people hit certain ages, they are required to take a distribution out of their IRA, whether they need that money or not. They have to take the distribution, and that distribution will then be taxable income. So the government's goal was not to have all of this money that's subject to future taxation never get taxed, to sit there for decades, possibly, maybe even generations. So they came up with these rules.
Yeah, and one thing we're seeing within our models within the RMD world is, if you don't spin that bucket and you just kick the can, right? Well, you're going to be required to take money out at an unknown tax rate that we feel is going to be unfavorable based on where we are today and based on the debt of our country. There's going to be a slide later about $31 trillion of debt. Well, how's that going to get paid? Well, we think higher taxes are coming. This also plays into your legacy play. If your kids or heirs inherit your IRA or 401k, right, they're subject to a 10-year rule, meaning they have 10 years to take all the money out. So they're basically, the government's letting you kick the can, down the road, not pay as much tax, potentially not take as much money out, but then your kids have 10 years. And usually how that works is when a generation passes away, the children are in their highest earning years, and then they have 10 years to add more taxes to it. So we have strategies in place to reduce your required minimum distribution, reduce the taxes you pay, and reduce the taxes your heirs or your children will pay in the future. And here's my favorite bucket, just because I have a famous person title, but here is the Warren Buffett tax bracket. Okay,
so this is long-term capital gains. And again, this is basically the sales of of your shares of company stock or ETFs or mutual funds. When you buy it, you get it at the basis, or the price that you paid for is what we call your cost basis. So if you buy 100 shares at $11 a share of AT&T stock, your basis in that stock that you bought is now $1,100. If 2 years from now you sell it for $2,000, you reduce the $2,000 that you received for the sale by the $1,100 cost basis, and that creates a $900 long-term capital gain. Now, a couple things that are interesting is long-term capital losses and short-term capital losses can reduce long-term capital gains. So if you had other transactions that created losses, that $900 that we talked about with the AT&T stock can be reduced by those losses first and foremost. And then they go under the Trump tax cuts. They have 3 buckets that long-term capital gains can be taxed at: the 0% bucket, the 15% bucket, and the 20% bucket. Now, it depends on your status, your filing status, and how much income you have earned. If you're under, like, let's say married filing jointly, and your taxable income's under $70,000, including your long-term capital gains, you pay 0% capital gains. And that is actually a strategy that we look at for some people. And then typically most people fall into the 15% bucket. That's somewhere above $250,000 of income that you become a 15% tax, or I'm sorry, over $70,000, you're in the 15% bucket until you get to $500,000 of long-term capital gains, which then becomes taxed at 20%. Now that's the capital gains tax rate. Anything you want to add there, Luke, before I move on?
Yeah, I wanted to jump in really quick. So this capital gains bucket is if you have a brokerage account, like an individual account, a joint account, a trust account, if it's irrevocable, or sorry, if it's revocable, the trust, so these are dollars that are not in retirement accounts, not an IRA, not a Roth, not a 401k, not a 403b. This is you taking money out of your savings or checking and you buying stocks.
And it's also important, it's not, we're focusing on it because we're talking from the financial investing area, but it's any capital assets. The sale of your house, if you don't get a primary residence deduction, creates capital gains. If you were able to sell your car for a profit because you had a collectible car, those all create capital gains and losses.
Correct. Sale of rental properties or businesses, or anything that you sell for more than what you bought it for, essentially outside of a retirement account, falls into the capital gains bucket. If you held it for more than 1 year, it is long-term capital gains. If you held it for less than a year, it is short-term capital gains and subject to your ordinary income tax.
That's correct. Now, on top of that, there's another tool that the government has brought in to try to collect certain expenses. And we've told you that, we're spending, we have this huge deficit, and they're looking for ways to pay for costs. Well, they came up with what's called the net investment income tax, affectionately referred to as NIIT. Essentially, it's a Medicare surtax. So in certain circumstances, if your capital gains reach certain amounts, they layer on top of the 0, 15, and 20% rates a 3.8%. So if you have investment income, capital gains and such that exceeds $250,000 for married filing jointly, not only are you going to pay the 15% capital gains tax, but because you went over 250, the entire amount is also subject to 3.8% of NIIT. Several rules can also be looked at with regards to long-term capital gains that get into some more complicated tax planning. I mentioned the sale of a personal residence. So if you live as a primary residence in a home for 3 out of the last 5 calendar years, if you're married filing jointly, the first $500,000 of capital gains is excluded. It is not taxable. It is excluded from taxation. Most people fall into that. If you're an individual, it's $250,000, and you can do this every 2 years. But the test that you have to pass is that it was your primary residence for 3 out of the last 5 years. We also use Section 1031 transactions, which is also referred to as a like-kind exchange. It's typically focusing on investment properties, so you can't do this with your primary residence. But if you have a rental real estate property and you want to get into you want to get out of that property and move into another property, maybe because of location or the size of the house that you're looking for the rental, you can go ahead and take advantage of Section 1031. It's pretty complicated, a lot of steps that you have to follow, but essentially the sale of the original home does not create capital gains. And then the purchase of the second home, your basis from the original purchase carries over. So that gain remains intact because you have the same cost basis, even though the second home might have cost an additional $500,000, you still only get the $100,000 basis from your original purchase. And then you can wait and use that as a tax deferral strategy as well. And then there's also wash sale rules that look at whether you trigger losses and then turn around within a certain period of time and buy that same stock at the same time, or same stock. That wash sale disallows the loss. And then for the real estate renter or rental properties, we also have depreciation. So when you're out renting your house over the years, one of the deductions you get to take is a depreciation deduction, which is essentially what you bought the house for divided by 27.5 years. That gives you an annual depreciation expense amount that you can use to offset your rental income throughout the years. Well, when you sell that property, that depreciation reduces your basis, so it creates a higher gain. And then the IRS requires you, instead of getting to treat that all as long-term capital gain, whatever has been depreciated over the years gets recharacterized from long-term capital gain to ordinary income, and it falls into the fully taxable bucket.
Yeah, and I would add the Section 1031 transactions. This is how, individuals or, famous people, right? The Trumps, in any big name that has a lot of real estate property, this is how they avoid paying taxes on it, right? They take the depreciation now, right? When that depreciation runs out or gets too low, they exchange the property in for something bigger and they redepreciate it. And then if, depending how it's structured and how it's titled, right, when the original owner passes away, right, it goes to the kids and they get a step up in basis and they do it again. So there's a lot of wealth that can be made in the real estate world, and it's by utilizing a lot of these. I mean, they're not even loopholes. I mean, they're pretty common rules within the IRS tax code to avoid paying taxes and to, be able to depreciate and even take losses on your tax return while you have properties that are producing income. So there's some really good strategies around this. If you have a lot of real estate rental properties, commercial properties, let us know if you want to have a conversation. We can help on that, kind of help plan that out for you. That could be a legacy play as well. Mark, you touched on the capital gains tax rates there, but here's kind of the brackets themselves. I don't know if you want to jump into this a little bit, but you have the capital gains plus the NIT over there on the right.
Yep. So I guess I did kind of go over this a little bit, but essentially, if you look at the 0% tax rate bucket, if you're single and your income falls under 41,675, any long-term capital gains that you earn during that tax year will not be subject to any federal tax. That number jumps up to 83,350 if you're married filing jointly. So those are the two main ones that you usually see. Again, we actually have a little bit of a nifty tax play on this. If you know that you're not going to be earning that much income and you have some appreciated stock, you can go ahead and sell some of that stock to trigger the gain, turn around and buy it right back and get that step up basis. The gain that's triggered from the original sale isn't taxable because we've left your income in at a certain amount, and then you get that step up basis. So that gain will never be taxed going forward. And then we talked about the NIT. Again, that's a Medicare way of paying Medicare additional funds, and it's supposed to be looked at as a tax on the wealthy.
And as we go through the 7-part series, you'll hear Mark talk about the perfect tax return, or paying 0% taxes. Well, some of it could be you could still have income, right? You can still have your standard deduction offset things. You can still have capital gains tax up to these, or capital gains up to these thresholds, and pay 0 taxes. So we're going to show you how we get our clients there and how, it makes sense to at least run the analysis to see if it makes sense for you on how to get you to the 0% tax rate, because then you can start selling, shares of Apple you bought 15 years ago, right, for zero tax. So there's a lot of ways to get you there. It costs you some tax now, but we think we're in a favorable tax bracket. But this is going to play into some of our future videos of how you can sell things without paying tax, and it's based on these thresholds. So our last bucket here, I'll have Mark talk about the tax-free bucket. Of course, this is very important, but not all of your money needs to be in here to be tax-free. I'd say some of it or most of it, depending on your expenses and income needs in retirement. But of course, this is where we'd want all of your money, but it doesn't have to be there to get you tax-free.
Yeah, so I know we've mentioned it, but it's a Roth IRA, it's certain insurance policies, municipal bonds, any income generated out of these tools come to the grant or to the investment holder tax-free, meaning it does not show up on your tax return. It's very helpful, this bucket, as we mentioned before, with a new roof or a car purchase or a dream vacation, where you have a budget that you need to work within. You want to keep your taxes low for a variety of different reasons. You don't want your taxable income to get too high for some of the other planning that you're doing. So you use these buckets to help pay for some of those expenses. We also use this bucket strategically, speaking to the new roof and stuff, but even just if your budget's 100,000, but you jump up and pay a little bit of a higher tax rate if you go over $90,000 of taxable income. So you might decide every year, okay, I'm going to take 80,000 out of my 401k, and then the other 12,000 comes out of this tax-free bucket, so that I avoid jumping up to a higher tax bracket or pushing my effective tax rate on my income a little bit higher than it needs to be. We also use this bucket. We're going to get into it in a future slide deck, but Social Security has a specific way of determining how much of Social Security is taxable. If you earn basically more than $40,000 of taxable income, your Social Security is taxable income at 85% of your total benefits. And those are your gross benefits that you receive, not the net benefits after you pay Medicare and withholding on your taxes. So using a tax-free bucket to try to see if we can reduce how much you pay on Social Security is a really smart tool for those that are looking to have a budget of under $100,000 a year. And then lastly, we kind of talked about how a traditional IRA or a 401k that gets inherited by your kids, they have to take distributions out of that IRA within 10 years of you passing, which means that all goes to them taxable income. Well, if you leave a Roth IRA or life insurance to your kids, with a Roth IRA, they still have 10 years that they have to liquidate or distribute all the assets out of the Roth IRA. However, during that 10-year period, that can continue to grow. They can continue to aggressively invest it. That Roth IRA could double, maybe even more in 10 years. And then when they pull all the money out and liquidate the Roth IRA, none of it's taxable.
I'd add to this as well that having income in retirement, or even, right now, or if you're not retired, having income that does not hit your tax return has a huge impact when it comes to, of course, your tax rates, when it comes to Social Security taxation, when it comes to your Medicare premiums. We'll talk about that in a future video. When it comes to, if you have too much income, you can't do certain things, you can't take certain deductions, but this bucket here, if done correctly, does not show up on page 1 of your tax return, therefore giving you the benefit of that without all the extra taxes that come along with just your ordinary income tax. So this is our YouTube channel. We're going to have multiple videos to come in this 7-part series. We also, put some videos up here about our thoughts on the stock market. We have our podcast come to this channel. So if you want to subscribe to us, like the video, you'll be able to get these, before we can, send them out to you via email or however you receive them. But please subscribe to our channel. When we look at our firm here at McPherson Financial Group, right, some of the services we offer, right, of course, we're very educational in tone. We want to teach you to make the right decisions when it comes to your retirement planning. but we do wealth and investment management, our retirement income strategies, legacy planning, long-term care planning. We haven't talked about that at all, but tax planning and prep, Mr. Mark Bernard, and of course, estate planning. So all these services are offered here in-house. If you want to contact us, here's our information, our phone number, our website, my email, Mark's email, Art's email. Anything you want to add to wrap things up, Mark?
No, we're really wanting to do a lot of this educational material, and so you subscribing and hitting the like button really helps us to be able to put more time towards this. So we appreciate anything that you can do there.
All right, guys. Well, we look forward to more videos and hopefully answer some of the questions that you have. So stay tuned for more videos from McPherson Financial Group.